Welcome to Dollars and Cents, hosted by Sanjeev Gupta, CPA. Dollars and Cents is the show about growing more of what you are making, saving more of what you are growing, and making more of what you are growing and saving in the most sensible and tax-efficient manner possible. Feel free to call into our studio number to be live on air with your questions. Call 408-912-5038. That's 408-912-5038. And here is your host of Dollars and Cents, Sanjeev Gupta, CPA.
Good evening, friends. This is your own CPA, Sanjeev Gupta, CPA. We know the tax season is going on. May 17th is the deadline for filing taxes for individual taxes. So a busy time for CPAs, tax professionals, taxpayers, busy time for everybody who's looking to file the tax returns. In our show today, we're going to touch topics relating to things to take care of while preparing for 2020 tax returns. We'll go through some of the pointers towards preparing your taxes so that you have the information that is required for filing those returns. Let's go to our first segment, which is about dollar update. So I have two updates for you. In the meantime, if you have any questions, you can call the studio lines. Studio lines are open, 408-912-5038, 408-912-5038. I know there are a lot of questions up in your mind, being a listener and wants to file your taxes, maybe relating to PPP, maybe related to EIDL grants or restaurant grants, or maybe relating to EIP, stimulus payments not received, or maybe relating to American Rescue Plan Act, which changed the total tax scenario for a lot of tax filers. So you have those burning questions and you want an answer to those questions, and you're not getting that answer because CPAs are too busy right now. So this is time to call the studio line, 408-912-5038. 408-912-5038. So we have the $2 update for you. One is very important for a lot of business owners. They have been looking for this for several months now. It's relating to ABAT, which is about deducting the expenses paid with PPP loan forgiveness for California tax purposes. We know the federal, you can take the expenses which you have incurred by using the funds from PPP. You can use those expenses again on the tax returns for corporations, Schedule Cs, LLCs. What about the California? So now ABAT has been passed into law. With that passing into law means now the California taxpayers can include those expenses as deductible expense on the California tax returns and is in line with federal tax returns. But hold on, it's not so easy. There's a provision that they said relates to the 25% reduction in the gross receipt. So that test is still there for deducting those expenses on California tax return for 2020. I have a caller here. Let me take this call. Good evening, this is Sanjeev Gupta, CPA.
Good evening, Sanjeev ji. The question I had was, as you're talking about the tax return, I am almost done with drafting my tax return. The question I had was, I was on the last stage, and the option coming in is like you can also save some taxes by contributing to the IRA. That's what the option I'm getting on the TurboTax. The question I have is, for the limits for contributing to IRA, in my understanding, if you're married filing jointly, it's $196,000 in total, and you can contribute up to $6,000. But when I'm doing it in that, there's a reason, meaning it's not showing me a tax deduction appearing as a prospector deduction. Is there a reason, meaning if my income at individual level is about a certain limit, above that certain limit, still I cannot get a tax deduction, even though my AGI is within the limit?
Very, very good question. And I thank you for this question, which is important for a lot of listeners listening in. So now coming to deduction for money put into IRA, of course, there's AGI limitation. They say AGI limitation. When you talk about AGI, means your total income from different sources, from W2, business income, stock gains, any other income that you have. So you have to total up all those income comes under AGI. Now, if that income exceed a certain limit, maybe 150, 196,000, merit filing joint return, definitely that deduction will not be allowed. But there's certain other elements inside it. Number one is, do you have a 401k plan? If you have a 401k plan and you're contributing to 401k plan, the limits comes lower for the spouse that have a 401k limit, 401k contribution. For non-working spouse, the limit goes higher. There's no limit basically for non-working spouse. But if both the spouse are working and both the spouse are contributing to 401k, or their company has 401k plan, their limits are lowered. It comes down to around 150 to 170k merit filing joint. So if you are contributing to 401k, both of you, then the limits are lower. If one of them is contributing, the limits are higher. It can go up to 196,000. That's the limit. So that being said, so you have that regulations there. So you are not seeing that contribution on the adjustment of the 1040 because of the income of the increase of the AGI limitation. Plus, you might be contributing to 401k plan. That's the reason why you're not seeing that. But it will be treated as a non-deductible IRA, and that's also a very good area of planning. So you put that money into non-deductible IRA, means you put into traditional IRA, provided you don't have any other pre-tax IRA contributions. So if you don't have anything like that, contribute to the post-tax into traditional IRA, and then you can convert to Roth. And that's another way of getting the tax-free income growth in that IRA. Does it make sense to you?
Yes, it does. One follow-up question I have is, are you saying that like the merit filing jointly is the IRS rule is $196,000? Am I right? Right, that's the limit.
Yes.
If you go above it, there is a phasing out happens, right?
Yes.
So that's what I understand. But the one clarificatory comment I want to ask you is what I missed in your responses. If I have a 401k contribution which is active, yes, it is. Just because if I have my wife doesn't have, let's say in this example, even though the income is still below 196 grand AGI, in this situation, you don't get the $6,000 as a deductible IRA. Is it because there is additional limit down below it, or something I missed?
Yes, there's an additional limit down below it for the spousal IRA as well. Okay.
Thank you, Sanjeev ji.
Thank you. Really appreciate that. Question was great. So any listener, if you have any other question, you can always call. The studio lines are open, 408-912-5038. 408-912-5038. So coming to our dollar update relating to AB80, which relates to the deductibility of PPP loan forgiving expenses on California return. So if you are that LLC, if you are a S corporation, if you are a C corporation, if you are Schedule C and have those expenses which have been used for PPP loan forgiveness and want deduction, you can do that, provided this reduction in the revenue by more than 25% eligibility test is required. Now, whether this 25% reduction is in per quarter or on a yearly total, or it can be either way, we don't know yet on that one. We have to wait for the franchise tax board to come and guide us whether it's per quarter, any quarter 25% reduction like we have for PPP second round, or just over the period it's a total year reduction in 25%. So what I can safely tell to those listeners who have corporations and are looking for guidance in this area, generally see that if there's a reduction overall in 25%, and then go ahead and claim those. Don't do anything. The federal California conforms to federal, but if you don't see that reduction and you document that and you don't have document to say that it is a reduction, so don't add it as income on California return on the forms that we have for S Corp and C Corp. So don't so form 100 as and 100. So add those as income. That's important to note here. For self-employed people, sole proprietors, for the California return, you have to add as income, and you can add that one on your returns. We have one more caller here. Let me take this call. Good evening, Sanjeev Gupta, CPA.
Yeah, hi, Sanjeev ji. This is Venkat. A quick question for you. What are the new tax laws around inheritance tax or anything like that? Is there an inheritance tax from Indian rupees to US for a family, like from parents or something like that?
Okay, so what you're talking about is what you're hearing in the media is about the American Jobs Act and American Families Act, Families First Act, which President Biden is throwing in air, like for discussion and everything. We don't know yet what's going to happen. There are a lot of proposals inside it, lots of proposals which are going to impact the individual tax filers as well as business tax filers. We're going to talk about this as we get more insight into it. It's going to impact, like I said, a lot of people. And one of the provision in that thing was it wants to levy a tax on inheritances. So what is happening right now is if you pass on your wealth to your kids, and the kid take those wealth at fair market value. Now he's saying that he wants to change it. He wants to change it and give a $1 million increase in basis. Anything above $1 million increase in basis is going to tax it. Now we don't know any details. We just heard about it. It's in the media about it. We have to still wait for the final guidelines on this one and how it is going to take shape of. But we're going to talk about this in our next shows when we get more clarity from the Congress relating how this will be implemented. Okay.
Great. So just a follow-up question to your point. So as of, sorry?
Yeah, go ahead.
Yeah, as of today, for say, if somebody wants to get inheritance money from India, would there be any tax levied up to 1 million?
No. So as of today, if you want to take inheritance is after that. If you have an inheritance and you want to take that money, it's better to take the money today before that law becomes before those things become see the light of the day. So it's important that whatever you do it today, do it now. Yes, you can bring that money up to $1 million, up to $250,000 from India. Not million. Million is only used for sale of property. You can bring up to $1 million from there. But in case of any other transactions, you can bring up to $250,000 from there without taking RBI permission. So that you can do that.
Great.
There's no tax you have to pay.
Thanks for your information, Sanjeevji.
Thank you for the call and really appreciate your question. And listeners, if you have any questions, we are into 10 minutes of the show, and of course we have a lot of things to discuss. But I know there are a lot of burning questions in the minds of the tax listeners, and it's a tax season. So if you have any questions, you can call. The studio lines are open. 408-912-5038, 408-912-5038. So coming to this dollar update about ABAT, California deduction for PPP loan forgiven expenses, like I said, is important that you do it you do it properly and don't make mistakes, because Franchise Tax Board will be looking into this area. If you have any questions, you can connect with us after the studio. You can set up a consultation appointment and we can definitely guide you how to take care of it. The second update I want to bring is that restaurant revitalization grant is open for listeners who have restaurants. So or some eating places, joints, pizza places, or eating or some malls or strip malls where they're operating restaurants inside it and they're managing it. So for those people, definitely this restaurant revitalization grant is one of the best grant you can find out. Don't delay. It was opened on Sunday. Monday the application started, and already a lot of people have applied for this grant. It's not a big grant. A lot of people are, like I said, people are applying on this one. A lot of restaurant owners are feeling the pain, but they did get money, PPP1 and PPP2, provided they have payroll. A lot of people said that one client came to me and said, hey, I have a restaurant, but I cannot afford to run payroll. So that person laid off the employees. And because he laid off the employees, he did not get anything. So that's the problem with the restaurant owners. So this is a way of applying for this grant based on payroll. So this is not based on payroll. This is based on gross income. So if you did not make any income when I say income is gross receipt. If you don't make any gross receipt in 2020, when it compares to 2019, the differential is you can get a grant. This is a welcome grant. So this is a time to look into this grant. It's a small amount, not big amount. It's preference is given to women-owned, minority-owned restaurants. So don't delay this one. If you have, like I said, if you have any questions, you can call our numbers is after the lines after the show. The number is 510-825-7563. 510-825-7563. And like I said, a lot of people are applying for it. So don't miss this restaurant revitalization grant. I have a caller here. Let me take this call. Good evening, Sanjeev Gupta, CPA.
Hi. Hey, I had a question on RSUs. When you get RSUs from your company, it comes in as your W-2 income, and then there's usually a supplemental 1099-B, which you enter to kind of bring it down a little bit, or to just make sure that the capital gains are not too much. Is there any special trick with respect to RSUs?
No, what you said rightly. What you said is rightly. When you exercise RSUs, you see that income being reported as a benefit on your W-2 on the box number 12 or 14. You see that ESP RSU gains, and then when you sell it, you of course when you exercise, you see the 1099 broker statement, but sometimes they make a mistake. You have to go back and look at get a taxable income computation from your HR, or you can go back and see how the W-2 is computed and take the cost basis, and generally you will not be paying tax on that 1099 broker statement when you exercise. But when you sell it and you hold that stocks for more than 1 year, then you pay the long-term capital gains. But if you hold that stock for less than 1 year, you pay the short-term gains. But that's how it works out. But a lot of brokers are doing mistakes in terms of computing the cost basis, so you have to be careful when you look at the cost of those on your broker statements.
Okay, all right, but okay. The key information is the income in W-2 and then the 1099-B statement.
Yes.
Oh, okay. All right, thank you.
Thank you. I appreciate it, and we got a lot of good questions this time. Of course, I can understand it's a tax season. So listeners, if you have those questions and this is your time to connect with the CPA on air, call the studio line. Lines are open, 408-912-5038. 408-912-5038. Let's go to our tax topic of the show, which is about things to take care of filing the 2020 tax return. So number one important thing, first and foremost important thing is the filing status. Look at your tax return, what status you are taking into. Whether you are filing single or head of household. If you have a kid, you are taking care of the kid. No, kid is under age 17. If you're taking care of the kid and you're providing more than half the support and the kid is living with you, don't file single. File as head of household. Now, you get a preferential tax rates and a lot of deductions when you file as head of household versus single. So you have to look into that. What about married filing joint versus married filing separate? That's a big question. People always keep asking, can I file separate? Can I get more deductions? Can I pay less taxes? Remember, you are living in California. We like the air. We like the state, we like the green, we like the hills, we like the beauty of the California, but we have to pay taxes. And one thing which is there here is it's a community property state. When I say community property state, that means you cannot file separate return. You have to file joint return. If you want to file separate, the spouses have to live separate. They have to live separate, not in the same home. Otherwise, if you do filing separate and you don't apportion the income equally divided over two people, you will be subject to taxes. There is a form that you have to file, and that form is always there. People mess it around because what they do is W2 if W2 is one spouse name and W2 is and another W is another spouse name, they don't divide by two and equal amount is reported on those forms. So they make a big mistake on that one. So when you're filing separate return, remember the spouses have to live separate, and then it makes sense to file a separate return in the state of California. Outside California, if it's not a community property state, it makes perfect sense to file separate return. Perfect sense to get a lot of deductions, perfect sense to get unemployment compensation, non-taxable, economic impact payment, stimulus payments, we call it. You can get those areas. What about the itemized deduction like medical expenses, charitable deductions? All those 9 yards are great when you file separate. But remember, you are living in a community property state, so be careful in that area. We have 5 minutes and I have a caller here. Let me take this call. Good evening, this is Sanjeev Gupta, CPA.
Hello, sir. Very good afternoon. Thank you for your time helping us.
Thank you. Thank you.
I have a question regarding on the property taxes, how much returns we can gain. I am hearing different news like if your property worth, even though if it is 1 million or 2 million, whatever your gains are limited to the tax cap, something like worth of 750K property taxes on top of it. Is that something? Could you please help me understanding a bit more there?
So are you talking about the changes that happened with the property tax assessment, or you're talking about tax return deductions for those property taxes?
No, not the assessment, but the deductions.
Okay, tax deductions. So you have to understand this clearly for our benefit of the listeners, other listeners too. So property tax is bundled up with state taxes. Together, you cannot take more than $10,000 on your tax return. What you're talking also about was about the $750,000. That is a limitation on the loan amount for claiming the mortgage interest deduction, not property tax deduction. Property tax is bundled with the state. So if you have a property tax of $15,000 and your state tax deduction of state tax is what you see on the W-2 state tax withholding. So if your state tax withholding of let's say $15,000, property tax of $15,000, so your total bundled up total amount is $30,000, but you cannot get more than $10,000. So $20,000 of those amount will not be allowed as deduction on the tax return. With respect to mortgage interest deduction, mortgage interest will be limited to the interest you can claim up to a loan amount of $750,000 loan amount. If the loan amount exceeds $750,000, the interest on the surplus amount above $750,000 will not be allowed as a deduction on your tax return. Okay, I hope I clarify your point.
Yes, sir. That clarified a lot. Thank you very much.
Thank you. Really appreciate the call. And we're coming to very close of this show, but I want to go another area for this. We'll be covering it in another show also about the things to take care of while filing the 2020 tax returns. May 17 is the deadline. So I talked about the merit filing joint versus merit filing separate. And then I talked about the address. Address on the return is so critical this time. Pay very good attention to the address. Address is the point which says which is your home state. How can you claim the mortgage interest deduction? Can you claim home office deductions? It depends. But address is important on the tax returns. What about the dependents? Dependent is one area which will call for definitely a lot of discussion, because dependents impact your stimulus payment. Dependents impact their separate filings, their student loan deductions, the child tax credit, the child and dependent care credits, you name it. So dependents are so important. So remember the definition of dependent. Dependent must be a person who is not paying for more than half of his or her support, dependent on you, staying with you, being a citizen resident of US. So if that person is qualified dependent, you can claim it. But if the dependent is making more money, can you claim it? No. Can they claim stimulus payment? Yes. If they have not received it, what should they do? Well, it depends upon the 2019 return. So remember, when you're looking at doing the 2020 tax returns, look at the total income, which I just said, total income is inclusive of all income together. Look at 2020 income and look at 2019 income. If 2019 income is lower than 2020 income, don't file the return for 2020. Wait, hold on. Get that stimulus payment number 3 in account. If you have not received it so far, you can call the IRS and find out. If still not received, then you can go ahead and file the return. But if 2020 tax return income is lower than 2019 tax return, then go ahead and file as soon as possible. It's very important. We are going to cover in the next show more things about the things to take care of while filing your 2020 tax return. With that, I want to wish all of you the best of health. We know the situation in India is getting worse day by day. Just be careful of people coming from India. Keep a safe distance. Wear your mask. Do the vaccination as much as you can. We should not have this virus affecting us.